New Zealand has piled more than $160 billion into term deposits like punters crowding into Eden Park for a World Cup final. And now the crowd's getting restless. Returns are falling, inflation's chewing away at their hot chips, and the referee, otherwise known as the Reserve Bank, is blowing the whistle on the OCR. The big question is this: when the money stampede begins, where does it run? Into property like a winger charging down the sideline? Into gold like a safe pair of hands under the high ball? Or does it vanish offshore faster than the Warriors' finals hopes? Today, we're unpicking the brilliant mind of Mike Taylor, founder of Pi Funds. He's here to explain whether Kiwi investors are about to score or just drop the ball.
Financial freedom faster. Financial freedom faster.
Now, if you're actually wanting to make money instead of sitting on the couch sulking, watching the neighbours place double in value while you hit refresh on Trade Me, hit the subscribe button. In 2025, more Kiwis are getting their property brains from this show than anywhere else. Be a trendsetter, not a sheep. Mike, is this $160 billion sitting in term deposits the financial equivalent of the All Blacks leaving Richie McCaw on the bench? Safe but utterly pointless?
Craig, I love the intro. Very humorous. Look, it's really amazing actually. I hadn't had a look at this data until we discussed it just before I came on this offline. It's really staggering. You know, the figure was 100 billion 2021, and it's just grown almost vertically to 160 as we sit today. And you know, the first thing you probably want to ask is where the hell did all this money come from, given that we've been in recession for a number of years? And of course, it came from the previous government, who threw money out like a lolly scramble for a couple of years. So all that COVID money basically went into TDs, and that's been where it's sitting. And TDs have been a great place to park money. You have been able to earn 6% kind of risk free for a number of years. However, that party's over now. Term deposits with a 1-year rate, somewhere with a 3 handle now, and probably going lower, particularly if the Reserve Bank does what they've been needing to do for a long time. Maybe the new governor will do that and get rates down to something like 2.5, or to a level that's going to stimulate the economy. And if 2.5 is the OCR level, then you're not expecting much from your term deposit.
So you have said that gold is running hot. Is that like relying on Dan Carter's left boot, reliable forever, but, could be too steady?
Look, I don't think that much of that money is going to find its way into gold. It's just not in the Kiwi psyche to be investing, billions and billions of dollars into gold. Maybe some people might have a bit of a punt on the side, possibly put 5% of their wealth into gold. But yeah, it's not going to be a big proportion of that. I mean, I suspect that the most people who've got those TDs are probably older, so they're going to be skewing to more conservative. And so, cutting to the chase, where's that money going to go? I think it's probably going to go back to where it's always been, which is property.
That said, Mike, inflation's running at 3%, and house prices, we talk to the likes of Kelly Eckhold and Nick Tuffley regularly. They're saying house prices next year are going to be raised maybe 5%. So when you take inflation into account, house prices are only going to go up 2%. You may as well keep it in term deposit.
Well, like shares, housing is a long-term investment, unless you're going in to do a renovation and then resell it. Most people aren't buying houses with the aim of flicking it in 6 months for substantial profit. So, people invest in property with a 5-10 year type horizon, and similar, I guess. I think a little bit of that money will make its way into shares, Australia, New Zealand, through fund managers and direct stocks, fund managers like Pi Funds. But by and large, I do think it goes back into property. The challenge this time around for property, I guess, is that the costs of holding are a lot higher than they were 5 years ago. So it makes it the yield a bit harder.
It's not like the old days, Mike, where it was sort of winning lotto, though, when you sold a property. And particularly if you're having older, more conservative vendors, that money's not going to materialize quickly like the good old days.
No, you can't buy a property which is going to give you an instant kind of 8 to 10% yield for residential anyway. Uh, the yield's probably going to be half that, if not less. And then you've got all the rates and insurance, which have gone up significantly. So it is a different equation than it was before. But when people look at TDs and they see a 2% or a 3% return, it's not enough. They don't get excited. And I know that because we have started to see an inflow of clients coming back to us who sort of disappeared for a few years because they could get 6+%, come back to us and say, hey, we're not happy with 3. What can you offer us?
How old are your clients coming back? Like, for example, are kids who have been on Sharesies, are they really starting to grasp this idea?
I think it's generally still the older, more mature clients, those who, as I said, who skew to conservative. Typically younger generations who've got, 5, 10, 20 grand probably aren't worried about term deposits. They'll be punting on Sharesies.
We always ask the economists what they think will happen when the OCR drops further, potentially to 2.5%. It would be remiss if I didn't ask you the same thing. What does your crystal ball say?
Well, I think it'll stimulate the economy. It's what we've been needing for well over 12 months. We've talked about it on the show before. Finally, we might get there, albeit a little bit belatedly. But I think that should be enough to give New Zealand a little bit of a shot in the arm for 2026.
Are you sure, though? Because that's what we were saying this time last year. Survived till 25 and didn't eventuate like that. It seems uncertain times.
True. Although I do think that we're past the worst of it now, and so the economy is probably, in my opinion, back to growth now, and probably in the fourth quarter, absent any global shock, will grow this year. So a little bit of survive to 25, but maybe survive till the second half of 25. And of course, the RBNZ didn't really cut rates fast enough at the start of this year. Not to mention, they've had a lot of uncertainty around the tariffs globally in that sort of April-May timeframe.
I've mentioned this before in a few interviews as well. Confidence is the elephant in the room, despite the OCR cuts. It's a chicken and the egg. From your experience, how does confidence start? Does it start with the OCR cuts, or is there something else that the government has to do, bearing in mind we're 12 months away from an election?
Yeah, confidence or sentiment, Craig, is a really important thing, and it's hard to pick where it comes from. But I've got a feeling, based on feedback I get from our clients, that confidence sentiment has turned. Where does it come from? Look, I think it comes from markets bottoming, property markets bottoming, stock markets having a good year, and it comes from lower borrowing costs, which hopefully, all those things are in place.
Offshore markets are surging, but New Zealand market has barely moved. Do you think Kiwis are looking offshore to get better returns?
Yeah, well, they need to. I mean, if you've been stuck in the NZX the last few years, your returns would have been dire because we've been in a recession. An economy's in a recession. Typically, the stock market doesn't do very well. So it's been the right thing to have money offshore, not to mention that the Kiwi dollar's been weakening as well. So you would have made money from having investments outside NZ the last couple of years just from the currency falling.
Bonds are being sold as the steady alternative. Is that just a polite way of saying boring with lower losses?
Depends how you want to look at it. Yeah. I mean, most years, bonds are lower volatility, so your returns are going to be pretty close to the yield. You do get the odd year where interest rates collapse, and then you'll get a capital gain on your bonds, but you can get times like 2022 when there's high inflation and you lose money on bonds.
You mentioned in your last report a Green Day song about September. How have you found September? And I'm yet to see your report, so I'm expecting more lyrical, witty repartee in the next report.
Well, the interesting thing actually is that September has been fine. I mean, at the time we're recording this, it's still a couple of days to go. But the market has gone up. That's really surprised me. But yeah, we'll take it. Take the win.
How do you see the lead into Christmas with the OCR dropping and the like?
Look, I think some of the global markets that have run hard, like the NASDAQ and gold, are probably due a period of consolidation, due to have a bit of a breather. I'm not calling for a collapse, just a pullback. Who knows what the US has got in their bag of tricks for the end of the year. But I do think that the NZ economy has turned a corner. There's this announcement recently with the new governor should be positive, allows them to kind of clean house a little bit in there and set us up for a better 2026.
Are you surprised they went offshore?
No, not at all. I think that they were really unsatisfied with what was happening at the RBNZ, and they needed a new, fresh face.